Hi, Kyle. Thank you very much for coming on to the show.
Hey, Jason, super glad to be on.
So, for the listeners who may not know who you are yet, can you tell us a little bit about your background, what you're working on, and maybe go back to before your entrepreneurial days at Pristine as well?
Sure. So, my name is Kyle Samani. I'm a co founder and managing partner of Multicoin Capital. We are a fund that invests exclusively in crypto. So, my kind of quick story, I was born and raised in Austin, Texas, and that's where the firm is based now. I started programming when I was pretty young, about 10 or 11. Um, Went to NYU and studied finance, thinking I wanted to go work on Wall Street. When I got to NYU, I realized that was not my calling in life. After college, I came back home to Austin, started working in health IT, did that for a couple of years, and then started a company called Pristine in May of 2013 when I was 23. Pristine built software for Google Glass for use by surgeons. Grew that company to a few million in revenue, about 30 employees, raised about 5 million in venture, and then Google kind of pulled the plug on Google Glass. So I had a minor problem. Pivoted the company. The company was ultimately acquired, and I found myself unemployed in January of 2016. I discovered this thing called Ethereum in March of 2016, and Ethereum is what really drew me into crypto. I knew of Bitcoin prior, but Bitcoin had never piqued my attention. I was really drawn to kind of two things about Ethereum. The first was that, given that Google had pulled the rug out from under me with Glass, I was super excited for a platform that I knew that no matter what happened, no one could ever pull the rug out from under me. And then the second thing was the financial applications for Ethereum. And I studied finance. A lot of my friends were working, at major financial institutions, and I realized at one point that every major financial institution on the planet is just a giant smart contract. And when I realized that, I was like, oh man, this Ethereum thing is going to be pretty important. So that's kind of how I got into crypto, and just like started tumbling down the rabbit hole in early 2016.
Got it. So, like you mentioned, I like to focus more on Multicoin Capital and how it started. So, in a previous interview, you mentioned that you see a bifurcation of funds, right? So, there are West Coast crypto funds taking a more venture capital approach to investing, and there are East Coast funds driven by Wall Street guys. So, I'm curious, how would you define Multicoin Capital on this spectrum?
Yeah, so we think of ourselves as offering our investors venture capital economics with public market liquidity. So we kind of try and combine the best of both worlds. So, like the way to make real money in crypto is to identify, protocols and technologies that are nascent today and that will become worth a lot more in the future. Just like venture capital, buy things cheap and speculative, and hope they like become a real thing and change the world, and they'll go up in value. So we generally spend most of our time and energy thinking kind of in that lens. We are very technical, very comfortable going, down to the metal, talking to engineers, really figuring out like, okay, what is this thing? What's really the problem? What's really the solution? How does it really work? How is it different from its competition? All that kind of stuff. And then we kind of take that, and then we have a portfolio of assets that we, in general, think can grow very substantially in value, 10x if not 100x or more. And then we kind of combine that portfolio with the fact that our assets are liquid. And so liquidity changes a few things about our portfolio. The first is concentration. So if you look at a traditional venture capital firm, most VC funds will have between 20 and 40 investments in a given fund. The math for that's pretty simple. The math is intended to allow the maximize probability of catching a winner and then tripling down on that winner. But when your assets are liquid, that allows for concentration, because if you're wrong about an investment, you can just pick up your capital and go somewhere else. And so so we'd like to be more concentrated. So whereas most VC funds have between 20 and 40 investments, we will have no more than 10 at any given time. So a lot more concentrated. And then the second is we're not afraid to either adjust our portfolio for current market conditions or drop investments entirely that we've lost conviction in. So, there's investments we've made where we were super excited. They may have done well, maybe not so well, but like we've made the investment, and then 4 or 5 months later, we've since learned, hey, there's some material new piece of information that's changed our long-term outlook for that asset, and so we can drop the position. Um, and then that also doesn't prevent us from like selling down our portfolio, right? So if we think market conditions generally are trending downwards, we have the right to sell down.
For sure, for sure. And Multicoin is also a thesis-driven fund. So I'm curious as to, why choose the thesis fund over, say, an index fund or a purely macro-agnostic kind of quantitative fund. And speaking of pulling capital out and putting it back in, how do you develop these theses from start to finish, and do they really evolve over time, or Do you kind of decide on what the theses are at the very beginning and just go double down on those?
Yeah, so I mean, our theses do generally evolve. We already had a good sense for what we wanted them to be as we got started on the fund. But like the fact that we want to do a thesis fund is driven from really our core strengths, and our core strengths as a team are in like deep fundamental analysis, and that's at every level. So technology, product, sizing the market, understanding the token mechanics, assessing teams, that kind of full stack of like call it qualitative assessments. That's really where we excel. And so like going the thesis route versus the index route versus the quant route is really our forte. Having said that, we're not afraid to borrow ideas and inspiration from other types of funds. So for example, we have an engineer and a data scientist on staff. We don't do any algorithmic trading, but we do a lot of proprietary engineering and data science to kind of gather data, make sense of data, and ultimately use that data to inform our investment decisions.
Got it. So I'd like to move now towards some of the bigger investment ideas that you've either written about or tweeted about. So one of Multicoin's focus is, of course, on smart contract platforms, which is also what drew you into this space in the first place. And previously in an interview, you guys expressed the view that you believe the mainstream cryptocurrency in the future could be the native token of a smart contracts play as compared to, say, a purely currency-based coin like Bitcoin. So can you explain this view a little bit?
Sure. So there's kind of like 2 to 3 fundamental hypotheses on the investment on the assets that are going to become the largest. So like on the order of tens of trillions of dollars worth. So one hypothesis is the store of value hypothesis. And really Bitcoin is kind of like the poster child of this hypothesis. And this hypothesis basically states the only characteristics of the currency that matter are the things that make it a good store of value. And so like this means that it needs to be censorship resistant, right? No matter how many governments try and take it down, it needs to stand up. That means it needs to be immutable. That means it needs to be secure. And that means both it needs to be easy to physically store it, and it needs to be technically secure. Like you don't want a smart contract, breaking and like losing your money. And so like basically like a pretty minimal amount of overall utility. Just like, hey, you can like have a cryptographic key, you can store the key, and you're guaranteed that you can move your money. It doesn't matter if the fees are high, it doesn't matter if it's slow, it doesn't matter if it's not private, it doesn't matter if you can't make it flexible. Just like, hey, you can store the value, right? And like that's like, like just the most kind of conservative view of like what an asset should do. That view is largely modeled after gold. Gold, after the last 10,000 years, basically, the chemistry obviously hasn't changed by definition, and like gold is still considered a good store of value, right, for that kind of reason. So the idea of Bitcoin is basically like be digital gold or be a digital store of value. The other kind of major hypothesis is what I call the utility hypothesis. And this hypothesis basically states that the asset that becomes the most widely used will become the store of value. Basically, as more people buy it and use it, they'll hold it, and eventually that kind of turns into a self-fulfilling prophecy. And becomes the most useful. In order to be more useful, you do need to make some fundamental trade-offs on like some of those kind of core ideas I just mentioned earlier, things like censorship resistance or immutability or whatever, or security. Not to say that you need to make those so weak that like the system is unusable. Just like if you want to maximize censorship resistance, like that's fine, but you're just sacrificing a bunch of other things, to get there. And so like there's a whole bunch of forms of utility. There's not one narrow definition. We kind of have internally identified about 10 major characteristics of utility. So things like throughput, things like latency, things like scalability, things like governance, expressivity, privacy, these kinds of functions are kind of major platform level functions. And like all these different smart contract platforms that are coming out now, Bitcoin Cash falls in this bucket, Dash falls in this bucket, and then all the major smart contract platforms fall in this bucket. And these guys basically there's all these kind of fundamental trade-offs you can make in designing these systems. And these teams all have kind of unique views on like where they think there will be you've got an n-dimensional trade-off space. And these teams have fundamentally different views on like where they believe there will be a local maxima of value that accrues versus everyone else. And so there's people running all kinds of experiments now trying to figure out like where will value accrue in this n-dimensional trade-off space.
So, given that there are so many trade-offs between different smart contracts platform, how likely do you think that Ethereum will always remain as kind of like the premier smart contracts play, or do you think it's possible for other smart contracts play to kind of overcome Ethereum's strong network effects, both in terms of having a large community of great developers working on it already, and also a dedicated group of so-called hodlers backing it?
I put the odds for Ethereum being the big winner at 20%. So pretty low. And I put the odds of everything else, maybe Bitcoin 10%, and I put the odds of everything else like basically at zero, given current information. I think there's a lot of opportunity for these things to evolve. It is Ethereum's to lose, and it's very clear how Ethereum. There are lots of ways Ethereum can lose it. I think the most important is I think the network effects for these systems are very largely overstated today. I think network effects in these systems, as they're structured now, are remarkably weak, and that it will be easier and easier for both consumers and developers to port over to other systems, not necessarily at the current moments, but in the next few years as the tooling for all of the ecosystems matures. I think it'll become trivially easy to port kind of existing infrastructure over, which will ultimately reduce the network effect and the barriers to entry for other platforms.
Got it. Now, Kyle, you've also made some interesting comments about deflationary versus inflationary assets before. So for our listeners or viewers, Bitcoin is a deflationary asset, meaning because of an arbitrary limit of 21 million coins in the supply. If the demand grows, the value of Bitcoin likely goes up. Now, Kyle, you've written before that you are highly skeptical of currencies that are explicitly deflationary to create these types of upwards price pressure on the value of the token. So I'm curious, can you explain a little bit about why?
Yeah, so I mean, like the more I think about, like if I was designing a crypto economic system from day one, well, let me step back a bit. So I believe in the utility hypothesis, and I believe that is the hypothesis most likely to produce the largest winner. And so if you want to maximize the number of people using your system, then you want to minimize the number of barrier points of friction to get people onboarded. One of the most obvious sources of friction is transaction fees. At the end of the day, no matter what happens in these systems, you somehow have to pay miners or block producers or someone to secure the system. Like that's a fact. Now, how you choose to pay them is, at the system level, is a lot of design decision choices, but like they have to be compensated. So in the Bitcoin view, right now, it's some combination of inflation and transaction fees. And at some point I don't even think it's not too distant future. I mean, in the next 10 or 20 years, it might become, inflation and Bitcoin will become so low that like it might not be viable to run a mining business. Or transaction fees will just go through the roof to the point where the system will become basically unusable as adoption of the system grows generally. So one view is like explicit fees, and the other kind of general answer is inflation. And the thing about inflation is like it's a hidden cost. As a consumer, when you transact, in whether it's buying coffee or whether it's interacting with some dApp or like engaging in some contract for some future whatever, a derivatives contract, whatever it is, like at the end of the day, if you have no fees, like as a consumer, that's more desirable than having fees. Our kind of case in point of this is current credit card system. Credit card system today is called a 3% tax on the United States on consumers, but like that cost is just built into the fee you pay at the store, all right? And like consumers think like the credit card is free, right? Like it's perceived as free. And so like we just know like hidden costs are better absorbed by consumers. And so like I like inflation in a system because it allows you to compensate the block producers and the miners for maintaining the network without imposing an explicit cost on the consumers. There's obviously an implicit cost, which is the inflation, but I much prefer that as a way to onboard users. All of the economists, obviously, like generally, if you're an Austrian economist, you like hate this, and you're like, no, don't take my money from me, kind of a thing. But I think that's a kind of a very like self-centered view of like how to think about growing a system and like competing with existing systems like fiat currencies. And if like the number one goal is just get people to use it, I think it's much more important to reduce friction to get new people to use it than to have a very rigid view of macroeconomic policy.
Got it. Now, quickly jumping over to talking about business models, I think you're probably very uniquely qualified to answer this question, given that you were a tech entrepreneur outside of crypto before investing in crypto. And you've noted on Twitter before that a lot of crypto founders have terrible go-to-market strategies when it comes to launching their coins. So, as a person with prior founding experience outside of crypto, what are the things that crypto startups can learn from startups from Silicon Valley?
Yeah, so I mean, I think the biggest is like how to build like sales teams and business development functions to bring your product to market. So like these teams raise tens of millions of dollars, and sometimes they're now worth hundreds because the price of Ether's gone up since they raised their ICO. Like they have a lot of money on their balance sheets. I want to see these teams spend their money more on like sales and go-to-market marketing people and salespeople, not just marketing on CoinMarketCap, running Facebook ads to get people to buy your coin. That's garbage. But building strategies where you can systematically identify your target user in the real world, get in front of them, and get them to use your service. And that might require building partnerships. That might require doing direct marketing. Whatever the case may be. But like having a very logical and consistent and coherent strategy on how you're going to find these people in the real world, how you're going to get in front of them, what message you're going to tell them that's going to attract them to click a button and use your service, and ultimately how you're going to get them to like stay and be a repeat customer or a repeat user of the system. And like that level of like overall like funnel management or like customer life cycle is what's kind of traditionally called in Silicon Valley. That seems to be pretty light to non-existent in crypto.
Why do you think that is the case? Because some of these things like go-to-market strategies, customer lifecycle funnels, they seem pretty intuitive to Silicon Valley founders. So why do you think, especially in a space where there's so many technological talent like crypto, why do you think these things are more rare?
I think part of the problem is I think people have seen with Bitcoin and they think with Ethereum that like it was if you build it, they will come. And like that's just basically false. I mean, Bitcoin was largely an exception. It took people like Roger Ver espousing Bitcoin. Bitcoin nearly died multiple times, like in the early days. And I mean, it's truly a miracle that like Bitcoin stayed around, and that people like Roger and all the early evangelists, and Andre Antonopoulos, all those kinds of folks really espoused and promoted Bitcoin. And so like Bitcoin kind of sort of happened despite the lack of go-to-market function. But like people think with Ethereum, they think the same thing, like, oh yeah, they just built it and like people showed up. And like, that's just outright false. Vitalik right today is worth a few $100 million and the guy is homeless. Like he lives in an airplane because constantly is traveling, like talking to people and like giving conferences and like doing local dev talks and whatever. Like that's remarkable. Like having the wealth he has and being like, nah, he like doesn't spend any of it. And the guy absolutely busts some serious ass. Like people don't appreciate how hard it is to live in an airplane. It sucks. And he flies coach. Like he doesn't fly first class. Like, right. He like that level of discipline, to be doing the research, doing the engineering, being the face of Ethereum, like, and he's also like kind of omnipresent on social media. Like the guy is working 100 hours a week.
Yeah.
Right. And there's a level of discipline of like bringing that to market that it's not necessarily obvious until you kind of step back and think about it. I wasn't involved in like the Ethereum like planning days and the earlier stuff, but from what I've been told by a lot of people, the Ethereum leadership spent a lot of time kind of trying to find ways to find local evangelists in major cities and like get people excited, provide them funding, and like get people excited and building on it. Right? The Ethereum Foundation has spent a lot of energy doing this. Like this doesn't just happen magically. It takes real money and real time and real energy. And so people just kind of think like, oh yeah, everyone just got excited about Ethereum, and like that's like absolutely false. People were like laughing at Ethereum for a long time before like they became a real thing.
Got it. And you also brought up Roger Ver, which is interesting because it provides a good segue to this question. So in a previous interview, you mentioned that you are bullish on Bitcoin Cash, whereas your co-founder is more in the Bitcoin Core camp. And I'm curious, are there a lot of disagreements within Multicoin? And when they arise, how do you resolve them as a team and move forward with investment decisions?
Yeah, so we disagree about stuff all the time, and that's super healthy. We're an investment firm, and so we're making decisions about how to allocate our capital. And like, if everyone's in agreement on everything all the time, like it's a huge problem. We should be constantly debating things, and we do. I've been very publicly, I've kind of given up on Bitcoin intellectually. That doesn't mean I think Bitcoin has no upwards price momentum. I would be shocked if 19,000 is the all-time high price for Bitcoin ever. I signed the probability of that being the case at like near zero. Because like, although I intellectually am not a huge fan of Bitcoin and its current trajectory, it's pretty obvious that like as crypto grows as a thing, new capital will come in and like some of it will land in Bitcoin. And so just given that like pretty obvious fact, it makes a ton of sense to like generally be long Bitcoin, at least for the next year or two, if not longer. So like I can hold the opinion that I think Bitcoin price will go up, and I can hold the opinion that I don't think Bitcoin will in the long run be a success. And like those two facts, like although on the surface they look like they're mutually exclusive, they're really not.
Mm-hmm. Got it. Now, just to close off with two more questions, I want to focus on the very high macro level. What do you think are some of the more important trends that we will see in 2018?
Yeah, so I think a big thing people have talked about a lot this year are decentralized exchanges. We spent a great deal of energy on them in the latter part of 2017 internally, understanding the landscape of them, different design decisions of these systems. And we kind of thought that would be like the aggregate space of design decisions, and it turns out that was just totally wrong. In Q1 of this year, I have learned probably another half a dozen like fundamental design models for decentralized exchanges that I hadn't really considered before. And like there's a massive amount of experimentation going on right now and figuring out how to help people trade assets without having a central third party in the middle, a custodial third party in the middle. And like that's a huge opportunity in crypto. And so like there's a lot of people going after it. The general like demand and use case makes a ton of sense. It's not clear to me any of them will really work. The biggest problem with all of them fundamentally is throughput. You just can't like it's just hard to have highly scalable systems on blockchain blockchains to settle trades. So there's like a lot of risk there, but that's a very exciting space. There's tons, like tremendous amounts of activity happening at call it the DEX layer. The other layer that's like, I mean, super exciting to me right now is the smart contract layer. Ethereum today is kind of sort of the only game in town that really works. Neo is like nominally out, but like Neo doesn't really work in a meaningful way. Cardano is kind of sort of a glorified testnet right now. And like all the other smart contract platforms that are, I think are at least intellectually interesting, things like Hashgraph, like EOS, like Cadena, like Divinity, those aren't out yet. And most, if not all of those, are going to launch this year. And as those launch, we're going to finally start to see real competition for Ethereum. And so I'm excited to see the pace at which developers start porting applications over. So things like Cosmos, it should be trivial to port EVM-based applications over to Cosmos. And so I'm really curious to see kind of how the landscape of like somewhat competitive, somewhat not competitive smart contract platforms, like how that interplay works.
Mm-hmm, for sure. Yeah, the coming months for crypto will be absolutely crazy. And the last question for you, Kyle, is I'm interested in, what is one book or resource or maybe a piece of advice that helped you the most when you were first starting out in crypto, when you first jumped into this rabbit hole?
I would say like my biggest piece of advice is like find people who will challenge your views. It's very easy to get stuck in a Reddit community and just like live in that Reddit community. Yeah, like like Neo's the greatest thing ever. And like if you live in the Reddit community, like and you never go anywhere else, that's what you'll come to believe. And so you should like constantly look for people who will challenge your views on Twitter, on Reddit, on various forms of social media, and really try and engage with them intellectually. Like try not to troll people who disagree with you. And try to have a meaningful discussion, and you will learn a lot from that, both intellectually and in terms of ultimately making your own investment decisions.
Got it. Well, those are all the questions I have. Thank you very much for being on the show, Kyle.
Hey, Jason, thanks so much. It was a blast.
And back to our listeners. Thank you very much for listening to another episode of the Blockcrunch. If you haven't already, please follow me on Twitter at Mr. Jason Choi. That's MrJasonChoi, because I share the latest episodes and updates there. If you haven't, please also rate and subscribe on whatever platform you're listening to this on, because it does help us get this out to more people and help spread the crypto virus. Once again, I've been your host, Jason Choi, and I look forward to seeing you at our next episode.